Hello everyone. In this demo, I'll be presenting a project titled Data-Driven Intraday Market Analysis. The system is a data science-driven financial analytics platform that transforms raw market data into statistical insights, market regimes, and actionable investment decisions. The system uses data from the Yahoo Finance API. Here, the user can select any security, choose the time interval, select the historical period, for example, 1 month, but this is configurable. Why this matters? This flexibility allows custom analysis across different assets, adaptability to different trading strategies. Once the data is fetched, we apply pre-processing. Raw financial data often contains missing values, irregularities, noise. So we perform null value removal, time alignment, basic normalization, calculate returns, add volatility, add volume Z score. If we skip this step, returns become inaccurate. Volatility becomes misleading. Statistical models break down. This step ensures that the data is clean, consistent, and statistically valid. Next, we move to feature engineering, which is the most important stage from a data science perspective. Instead of using raw price data, we generate meaningful features. Returns captures price range. Volatility measures uncertainty. RSI indicates overbought or oversold conditions. Volume Z score detects abnormal activity. Rolling mean and standard deviation. Why these features were chosen? Each feature represents a different dimension of the market. The returns represent direction, volatility, risk, RSI, momentum, volume Z score, anomalies. Together, they create a multidimensional view of the market, which is far more powerful than using a single indicator. For each feature, we also compute mean standard deviation. Why this matters? This helps understand feature distribution, normalize signals, detect unusual behavior. This is a standard practice in data science to ensure interpretable and comparable decisions. After feature engineering, we apply statistical modeling techniques. Uh, Key measures Hurst exponent. It identifies whether the market is trending or mean reverting. Volatility measures market instability. Sharp ratio, it evaluates return relative to risk. RSI captures momentum behavior. Moving further, we also did various statistical analysis. We performed the JV test to check whether the data follows a normal distribution. Why this matters? Many financial assumptions rely on distribution properties. Helps validate statistical reliability. We use the ADF test to check if the time series is stationary. Why this matters? Non-stationary data leads to unreliable predictions. Stationarity is required for many time series models. Market regime detection. Using statistical measures, we classify the market into different regimes. We apply threshold-based logic on Hurst exponent, volatility, volume Z score. Example interpretation: high Hurst is trending market, low Hurst means reverting market. High volatility, risky conditions, high volume Z score, anomaly. Why this is important? Most systems ignore market context, but in reality, strategies must change with conditions. This makes a system context aware, more realistic, more reliable. The decision engine, which is one of the most critical components. Here, we compute a market attractiveness score using Hurst score, volatility score, Sharpe score, RSI score. What this does? Instead of multiple conflicting signals, we aggregate them into a single score, apply thresholds, generate a final recommendation of either buy, sell, hold, avoid. We also compute a confidence score. Why this matters? Not all signals are equally strong. This helps quantify reliability. Why this layer is strong? Because it combines multiple features, it reduces noise, uses statistical inputs that basically improves validity, produces interpretable output, which is easy to trust. And then we have the pipeline performance. We also evaluate the pipeline's performance. This includes signal consistency, risk adjusted outputs. For example, Microsoft. Uh, for Microsoft, we have these values calculated, and the decision basically that was made based on the data that we accumulated and the interpretations that we made using that. So for that, we can see the Hurst exponent is 0. The volatility is about 31%. Sharp ratio is about 4.46, and RSI is 74. In the detailed analysis, we can see that it is a mean reverting market. Prices bounce between levels, normal volatility. It is a standard risk. RSI is overbought. You should like wait for pullback, risk adjusted return. Excellent. So this is a basic analysis for NVIDIA. As we can see, the decision is hold and so forth and so forth. Because we have chosen only three securities, we have about the analysis of those three securities as of now. Across time, this ensures the system is not just function but reliable over time. Finally, we visualize everything using a three-page dashboard built in Microsoft Power BI. Why Power BI? Interactive, it is interactive and dynamic. It handles large data sets efficiently. It is easy to interpret. As we can see, so if we select, let's say, these three, if we select, let's say, Google, so we can see that the graphs are adjusted to the current values of Google. Let's say Meta or Amazon, Tesla. You can also select automotive sector. Or so Tesla is in automotive sector. So okay, and then we can change the years of since when we want the data and things like that. Then we also have a candlestick chart. It displays the open, high, low. So as we can see, the opening value was $214. The closing value was $222. High was of $222 and the low was of $213. This helps identify trends visually. It also shows how market uncertainty evolves. It tracks market state transitions, displays allocation and performance, as we can see for different securities. And yeah, so we have this Power BI dashboard. Now that we've analyzed the market and generated signals, the next step is translating these insights into practical investments decisions. This is where our portfolio builder module comes in. Here, the system allows the user to define their investment portfolio based on three key dimensions. What is their primary goal? Is it capital preservation? Is it balanced growth? Is it maximum returns? What is the investor experience level? Are they beginner or they have some knowledge about it or they're pretty well versed with these systems? Time horizon. For how long do they want to invest? Short term, medium term, long term, and the capital they want to invest. So let's say we could do it $1,000 for now. This why uh, this is important because in real world finance, a beginner investor cannot take the same risk as an advanced trader. Someone investing for the short term behaves very differently from a long term investor. So instead of a fixed strategy, our system builds a personalized portfolio strategy. Based on this inputs, the system generates a recommended portfolio allocation. The user selects the securities. The system determines how much capital should be allocated to each. How the allocation works. The allocation is influenced by risk level of each asset, market regime, volatility, expected return characteristics. In a capital preservation strategy, allocation shifts toward low volatility assets. In a maximum return strategy, higher weight is given to trending high return assets. To ensure proper diversification, we perform correlation analysis. We compute a Pearson correlation matrix which shows how assets move relative to each other. Why correlation matters? If assets are highly correlated, they move together. Risk is not diversified. If correlation is low, portfolio risk is reduced. We also compute average correlation diversification score. A higher diversification score indicates a more balanced and risk efficient portfolio. Next, we perform a risk analysis of the portfolio. This includes volatility analysis, overall market uncertainty, value at risk, expected worst case loss, conditional value at risk, extreme loss beyond uh, va- value at risk, Sharpe ratio, return per unit risk, maximum drawdown, worst historical loss. We also incorporate GARSH based volatility forecasting, which helps estimate future risk. Why this matters? Markets exhibit volatility clustering. Future risk is not constant. This makes the system forward looking and not just reactive. We also visualize drawdown history, which shows how much the portfolio has fallen from its peak, how quickly it recovers. This is critical for understanding capital preservation capability. Based on all these metrics, the system provides a risk classification, such as low risk, high risk, moderate risk. What this means is this helps the user answer, is this portfolio aligned with my risk tolerance? An important aspect of the system is that all of this analysis is based on real-time data. As new data is fetched, features update, risk metrics update, portfolio recommendations adapt. For example, if we change the time interval from 1 day to say 30 minutes and from 1 month to let's say 6 months. So the data is fetched in real time. As we can see, the data has been updated. The data is now for 30 minutes time interval for 6 months. And as we can see, the Hurst components, all the different market analysis metrics that we have used have changed. The risk analysis that we have done has also changed. The confidence has changed, the GARS forecast has changed, the conditional value at risk has changed, the drawdown chart has changed. Because these real-time data analysis makes the system dynamic and responsive to market conditions. So overall, this module ensures that investment decisions are personalized, risk is quantized and controlled, portfolio allocation is data-driven, diversification is mathematically validated. To conclude, this project demonstrates how a data science pipeline can be applied to financial markets by cleaning noisy real-world data, engineering meaningful features, applying statistical validation, making risk-aware decisions. The system is interpretable, robust, adaptable, and reflects a real-world production-oriented approach to financial analysis.
Let us utilize Power BI to visualize minute-level data, allowing us to move beyond simple spreadsheets and uncover actionable insights regarding our intraday trading performance and long-term portfolio growth. So, this is now let us start with our overview dashboard. Here we track 4 critical metrics. First is the portfolio value by sector. This bar chart provides a snapshot of our diversification. As you can see, the technology sector currently commands the majority of our portfolio value. The conclusion, our risk profile is heavily weighted towards tech, which is useful context for market volatility assessments. Then comes the sum of close by year. These trend lines track the closing prices for all of our tickers, which means all of our stocks. It allows us to compare growth trajectories side by side. Then comes the moving average. We've implemented a 7-minute moving average to smooth out the noise from the high frequency minute level data. It helps us ignore short term fluctuations and identify the underlying price trend more clearly. Then, lastly, on this page comes the sum of daily return by stock. This gives us an immediate performance scorecard. It highlights which tickers are pulling the most weight in terms of percentage gains, helping us identify our top performing assets instantly. Coming to the second page of the dashboard, Moving into granular analysis, we use candlestick charts for deep dives into individual stocks. Here we are looking at Amazon. Unlike a simple line chart, this gives us the open, high, low, and close data for every interval. By analyzing these patterns, we can conclude whether the market sentiment is bullish or bearish within specific time frames. For example, if we see a long green candle, it indicates strong buying pressure, while gaps in the data help us spot volatility breakouts. This is essential for fine tuning our entry and exit strategies. Coming to the third and the last page of the dashboard, we'll look at our long-term trajectory through the cumulative return chart. This chart is vital because it tracks the compounding effect of our investments from 2022 through 2025. It moves us away from looking at just at the daily price and focuses on total value created. The takeaway here is clear. It helps us identify which assets have consistently outperformed the market over time rather than just reacting to short-term intraday movements. In conclusion, by combining high frequency intraday data with these Power BI visualizations, we have created a robust decision making tool. We can identify sector weight, filter out noise with moving averages, analyze technical patterns with candles, and track long term cumulative growth. Thank you for watching this breakdown of our portfolio analysis Power BI dashboard.